Hey YouTube, I wanted to cover with you today how to get into real estate. This talks about allocations or portfolios, how to fund the real estate, how to look for it, how to look at the investment, and how to decide if that's kind of the right kind of asset class for you to buy. Rather than just kind of jumping off that bridge, it helps you understand what that whole situation looks like. So let's get into it. When to get into real estate. So in the last video we talked about how to start investing, how to establish an initial allocation, how to see what a target allocation would look like, and then a possible future allocation. Now, where real estate comes in is if you get to this target allocation and you are just killing it on income, squeeze that income, have your savings, and put that money into this kind of an allocation. If you can get it into tax advantaged accounts, it's even better. And just leave it. You're good. Okay. Retire at 52. You'll be fine. However, let's say you don't have quite as much income, and you're really looking to get to more of a net worth of, a multi-million or decamillion or things like that. You're going to have to do some additional things, because index funds, cash, and crypto today probably are not going to get you there. They can get you along the way, but they're not going to get to that point. So let's talk about real estate. And so if you look at the same target allocations we looked at before, this is where your allocation is today. If you're doing the things we're talking about, this is where your allocation is today. And a future where you have alternate investments, businesses, and real estate looks more like this, okay? And so the difference gives you about 30% of your money that's currently in index funds to use for that purpose. It gives you about 5% of your crypto, because you're going from a 10 to a 5% maybe allocation, and maybe 15% of your cash. Now your cash will fluctuate based on how big the opportunities are. But the way we're going to look at this, because we've set ourselves up to look at it this way, is real estate a good investment? It is, how does real estate look as an investment for me compared to what I'm currently invested in? And so you're looking at this index fund, and it pays you this $37.50 in dividend every month, paid out quarterly. And you look at that and the value and how much that's grown over since you've earned it, and you're comparing that to real estate. Now, if you just walk out and you just buy a house at straight market value, is that a better investment than this index fund? Okay? I guarantee that you don't know. And so that's not a good move to make, because when you buy an investment, you should have some type of understanding of what value is being created by you buying that investment. And so one thing you want to look at is at the purchase of that house, how much money do you make? Not how much money do you actualize into your pocket, but how much do you make? So let's say the house is worth $150,000. You can buy it for $120,000. Then at purchase, minus your fees, the difference is how much you actually make at the purchase. Now, alternatively, if the house is worth $150,000 and you pay $180,000 for it, then you're actually losing $30,000 when you buy it. And so that would not be a good move compared to your VIG or your ETF that you currently have, or your Bitcoin you currently have. And so you wouldn't make that move. So you're looking for a value of how much you make when you purchase it, okay? Second, in that same line, you're trying to determine what the effect on your net worth is of owning your current investment that you have, which is, for instance, VIG or Bitcoin, and what the effect of this investment might be. And that's where you can maybe understand some future growth. Now, I'll give you a few things about real estate that are interesting, okay? So in the price of real estate, there are two growth factors. One is the value of the dollar, okay? So if the dollar is going down in value by 7% like it does today, you're probably going to get 7% in that year your value of the house is going to go up by 7%. That's if it's not inflated currently. But on average, it'll go up with inflation because it's not going up in value. It's merely holding its value as the dollar goes down in value. Now, in actuality, that value is more pegged to average income in the area, but generally average income in the area tracks with inflation, if that makes sense. Your second one is on demand. Demand is hard to predict, right? Demand is a judgment call. I don't count on demand increases in value for pricing something, generally. I do count on inflationary increases in value. And so that's how I look at this value proposition. Now I'll get rid of this. There's too much noise on my screen. Passive income. Today, you're making $37.50 per month in passive income. You might take 30% of your money and be shifting that into real estate. What does the passive income look like? Now, there's two aspects to the passive income. I'm going to call one passive income, and that's going to be your profit and the whole kind of effect of having that property. Maybe any tax benefits or anything like that. And the second is going to be cash flow. Now, we're not going to make decisions on cash flow primarily because we have passive income down here. We have a savings rate. We have a buffer here. And so these things are going to allow us to look at our decision in first, how does it affect our net worth and the value to buy? Second, in income or profit. And third, in cash flow. One of the reasons we have a base is we look at this third. Now, another investor has to look at cash flow first. Does the property I'm buying cover the payment or whatever I'm paying on the property? They have to look at that first, and that gives you a different value proposition than a different investor. Okay? That is key. Because if you value things the same way everyone else does, you're not going to be able to see opportunities when opportunities are there. You're going to see the same opportunities everybody else does, therefore you're going to go after the same houses and you're going to pay the wrong amount. Now, the last thing is the overall effect of the investment, okay? So picture this entire wealth building operation as a box. Sometimes we make decisions on one area, such as real estate or no real estate, that could affect another area either positively or negatively. And so you have to kind of think about that aspect. And you don't always know the effect of that until it occurs. You don't always understand that real estate, for instance, can give you access to money. Always. You don't understand necessarily that the debt you might have on real estate is the protection versus inflation. And those things you might have to learn as you go, as you try different assets and things. But understand that there's definitely an effect here, synergies between businesses you can build, and what Charlie Munger calls the Lollapalooza Effect, which is similar to when I bought houses in 2019. Then all of a sudden they printed a third of the money supply. All the houses went up by a third. Okay, that wasn't an effect I counted on when I made that decision, but it did, propel that investment that I made, with debt and cash, into maybe the 550% return range in the first year that I held that investment. And so you want to think about those things. The possibilities of those have a value, even though you shouldn't make a decision based solely on those. Now, in funding this, which is the second item, you have your current allocation, and then secondly, you're at 50%. You have 50% of your money available for these type of investments as you shift from your target allocation here into future. Okay? And so that's going to be really important to you because now you have a source of funding. Now, are you just going to go out and sell your 30% investment? No. You're going to compare owning this to owning this, right? So now instead of saying, is this a good investment, what you're starting to do is say, should I be in this or this or this? Which investment is better? And that's when you make better decisions, is when you start being able to compare different types of assets that you understand between each other. And that's very powerful. Look at the passive income and the opportunity. Now, when I bought the first house, my passive income on that money went from probably $200 per year to $2,000 a year. That was a tenfold increase, which is pretty significant. The house I bought under market value, which mean it had an initial effect on my net worth. And the other thing I want to introduce you to is, if you are in this target allocation, you're heavily into stocks, even though index funds, and you're into Bitcoin, you're into cash. Now, as you go from here into starting to shift some of your money into real estate, your risk actually goes down. Real estate does not follow the stock market. And so where some people will look at the situation and say, buying real estate is a risk, I would look at the situation and say, after you're at this target allocation, after you have a base built up, buying real estate is not a risk. Buying real estate decreases your risk. And so you want to think about that. And so that makes things as alternative investments for you more of a, what situation should I be in that when I buy this real estate, my risk overall now decreases, as opposed to someone else who maybe jumps out from scratch, buys that same investment, and their risk increases. And so that is a risk-reward adjustment that you can do just based on the order that you make your investments. And every time that you can do something that is lower risk for you than someone else, that you actually make money, because risk is a tangible cost in any investment. And that is one thing people don't really understand, is the effects of that. Because they usually look at your money in your pocket from an investment and not at the net effect of the investment or the actualization of the investment. So if I buy a rental house for $150,000 that's worth $200,000, for instance, that $50,000 is real, okay? And 90% of the world would argue that it's not, that you have to actualize the investment. Now, if that was true, I would have to sell the investment to make the money, and that would prohibit me from having passive income, having additional growth, the Lollapalooza Effect, and all the other aspects that investment brings to the table. So by viewing it as that I have made the money but not actualized it, it allows me to actually double and triple that profits, where someone else, based on their belief, cannot do that. I just wanted to share that with you today, kind of give you a path of, how to get into real estate if you wanted to specifically. This would work for real estate, for a business you were starting that needed capital, pretty much for any type of investment that you're going to put, a focus on and learn that. Maybe what I would call an alternate asset class. If you like the video, like and subscribe. Down below, maybe give me a comment on what you want to see, what you want to understand, and I'll talk to you guys later.